So, Richard, can you explain the changes we made with like adding the compounding? Because I know the most important thing, or one of the first things we needed to do, was make something that is robust over a long time, so it doesn't fall off the cliff. Because for compounding to work, you need to be consistent, don't you?
Yes. So I suppose what we were trying to hammer home with the compounding videos was that people rarely think in terms of the time necessary in their investment or trading activities with a weak edge, the time necessary to have these very stable strategies that compounding significantly influences your overall results. So most traders, they might have a 1 or 2 year history, a hiatus in the sun. They've done well for 6 months or a year, and then suddenly they fall off the cliff. They will never experience the principles of compounding. It's only those traders and investors who have stuck to a particular system for long periods of time where that compounding effect really starts taking over and dominating their overall performance results. So that's what we're trying to hammer home in the video. And the secret to success in the trading game, and this is why I was so regretful about the fact that we hadn't discovered this approach in my 20s or 30s, where we could have done something about it, is that in all the time we've been stuffing around looking at different strategies, different investments and things, research and development, all of that thing, that amounts to nothing. What actually amounts to something is your ability to maintain something for a long period of time to get that benefit of compounding. So nearly everyone I know in the trading world, they're only thinking very short term. They fail to actually see where the real power of this trading enterprise and investment is. And it's not in your system. Well, the system has got to be robust. It's not in how powerful it is over a 6-month period. It's not how powerful it is over a 2-year period. It's how powerful and sustainable and robust it is over a 50-year period. That's where you convert, your small initial deposit, $100,000, to achieve these multi-million dollar returns in the long term. And that's what the likes of Buffett, Soros, and all of those investors have achieved, and the best fund managers in the world have achieved. They haven't done it in a year. When I look at the best fund managers in the world, their track records are 30, 40 years, 50 years. And that supreme equity curve you see is actually delivered by compounding as opposed to the actual system itself. The system is a method to get to that compounding equation.
I think be worth just clarifying how we're doing this compounding, because I think that's probably the basis of Darren's original question, and why is this different to what we were doing previously? Previously, we had a fixed stop loss, so we had a $500 fixed loss, so the worst we could ever take was a $500 loss. And that translated into a particular lot size, and that lot size was then fixed for that particular trade. But every new trade that comes along still went for that $500 initial risk. So what we've done with the compounding is we've changed from a fixed $500 risk to a percentage of account equity, if you like, or the available free margin within the account. So that if you started with $100,000 and a $500 lot, a $500 trade risk, you could call that a 0.5% risk. And so if you put in a 0.5%, the first trade you take will still be a $500 risk. But as the account grows, that dollar risk becomes larger, still only a 0.5% of your account balance. But as the account balance grows, you're getting more and more lots on the table, to the point where we actually ran out of MT4 available lot size. We hit 100 lots. I don't know how many years that was in, Rich. Maybe you want to clarify that. But
isn't that a good problem to have?
Well, we thought that was probably adequate in terms of showing the power of compounding. But then one of our members jumped in and said, well, hold the phone. You can actually get more juice out of this if you split your trades. So whenever we hit 100 lots now, we break that into smaller trade sizes so that we still deliver 2, 3, 4, 5 trades, whatever it is, still giving us that 0.5% risk on the table. But the net result of that is we could end up with 1,000 lots on the table.
Yeah, and the reason now that we can kind of do that is the nature of the performance we're getting from our strategies. Because if you've got like a very volatile strategy that, you know, has a year that hits it out of the park and then a year of a 50% drawdown, then the effect gets lost in that.
That's
yeah,
right.
it's all based on the balance, and so if we've got an edge in our trading strategy, well, that edge will be realised over time, and therefore the compounding takes effect.
Yeah, and I guess this is why you know, a lot of the funds and that are so obsessed with drawdown, because I know in the past I didn't really mind having very large drawdowns because I traded a fixed lot. But when you start looking at the long term, the advantage of being able to compound makes it worthwhile trying to reduce these drawdowns.
Well, a fixed percentage gives you that fixed risk every time. But if you've got a strategy that's not doing particularly well and you start losing money out of your account, that 5% or 0.5% risk is actually reducing also. So you probably, if you had a really lousy strategy and it went broke over a year using a $500 lot fixed, it'll probably last you 10 years at 0.5%, because it'll just get smaller and smaller lot size. So you can probably live longer in even a bad situation. You'll probably last longer in the trading world. So the fixed risk, I think we need to probably still talk about that a little bit, Rich, in terms of the fixed risk is probably still the better way to go in optimizing, or not, because
so what we're talking about when we're talking about compounding, we're talking about the impact of leverage on our return stream, because as we see with the equity curve, if we apply a fixed dollar risk or a fixed lot, we find that as our equity builds, our position size on a pound for pound basis dilutes in relation to our equity. So you immediately see a higher drawdown in the early years, and then it tapers off to almost an infinitesimal drawdown in the future as your equity builds. But what we want is, with the compounding effect, we want to apply this stationary position risk based on trade risk percentage. So therefore, our strategy, irrespective of the level of equity, is still performing to the same level. But so when we test our strategies, or we test what's going on in the underlying market, we deleverage the return stream. So in that example I did of the video where we talked about, is trend following dead, I wanted to look at, has trend following got progressively harder over the last 50 years? Now, to be able to see that in action, you've got to deleverage the equity curve you get, because that volatility you get in the equity curve and that magnificent equity is dominantly contributed to by compounding, not the nature of the markets themselves. So when you extract that effective leverage out of your equity curve, you can see what's going on in relation to the underlying market performance. And so we saw from the 70s up to the year 2000 this spectacular trending environments and strong growth in our equity curve. But then subsequent to 2000 going onward, we saw it progressively get harder and harder. Trends were still occurring, our equity curve was still rising, but our rate of ascent in equity curve was significantly tapering off. And that's what the trend following community has been going through over the past 50 years. We had the marvelous success of the turtle story back in the 80s to the 90s, but trends were different then. It's got more competitive. The markets have got tougher for trend following. They still work, but if we had our trade risk percentage applied, you wouldn't see that effect, because it's compounding that's growing that equity curve. Does that make sense?
Yeah, total sense, mate. So are we doing the position sizing on the portfolio as a whole, or does it, because each of our strategies contains multiple strategies and that all comes together in a portfolio? Is it done at the portfolio level or like the individual strategy?
Okay, so at the moment, when we're doing our testing, we're applying a percent trade risk to each of our strategies, and we are applying the percent trade risk, not the fixed trade risk now. Now that we've undertaken our testing, we've identified they've got positive expectancy. Now we're testing on the percent trade risk. However, when we get to the portfolio level of consolidating these return streams, there's a bit of treatment we need to do between the different return streams themselves. So look, we'll discuss that later once we've done it, but there's a bit of scaling to do, there's a bit of drawdown treatment to do to get a balanced representation of our return streams across our markets into a portfolio. And then there's further treatment you do at the global portfolio level, which is basically the overriding gear stick for the entire portfolio that can turn the heat up and down. So we need that. At the moment, we're at the individual instrument level or market level, but there is treatment we need to do when we consolidate these into a portfolio, and there's stuff we need to do at the global portfolio level to manage our overall risk exposure. So Fred and I'll be dealing with that as Fred's now onto the developing what we call a combo trader, which allows us to aggregate these different systems that we're looking at. So at the moment, the systems that Fred's done, I'm probably stealing your limelight, Fred, but we've done the Donchian trader, we've done a breakout system trader, we've done a moving average trader with a take profit condition, and a moving average trader with a trailing stop. We'll also be doing a Bollinger trader. Their different systems will be, with the combo trader that Fred's developing now, will be basically interrogating all of those results of those different systems and then compiling portfolios that produce the best risk-adjusted return bang for buck out of all that we have on offer. But Fred, maybe you should discuss it a bit more, mate. I shouldn't have stepped on your turf, mate.
Yeah, I don't know that you actually answered Darren's question. The answer, Darren, is that every trade is considered independent, and each one is then set up with that 0.5% risk or $500 risk. So at the moment, we are just treating them as individual trades. But moving forward, where Richards was trying to explain was when we start combining these in a larger sense, we will be doing some scaling to try and even that out. But
Yeah.
even seeing those results on trade by trade, same risk, we're getting acceptable drawdowns. If you look at the report. Rich, you want to show us the report on that? I haven't seen coffee run before. What does it look like?
Okay, so this trade that's been going on in the background is using that Donchian trader with coffee as a market. We'll have a look at the report. This is over a 20-year. I'll just check. Yep, we had this over a 20-year test period here. We'll just go to the report.
What was the strategy that was running there?
We were using the Donchian trader as our strategy. So that was the Donchian breakout technique with the trailing stop. Just to go into I'll just bring up we only had in this particular version 4 variations of strategy working. So with Donchian periods ranging from 150 up to 450, a bit of variation in the ATR. The initial stop was ranging between 2 and 5, the trailing stop between 2 and 8, and the break-even multiplier. That tends to coincide with this stop-loss multiplier, but they're the settings there. So
we'll pull up the performance file, Rich, because it gives you that same data again, but it gives you just a little bit more.
Yes, so Fred's been really busy enhancing these things, which is absolutely fantastic. Wait, what I do?
Not that one, mate. Oh, you've got multiples in there.
Yeah, I've been on coffee before, mate. I've been a busy beaver over here. Okay, so these are the 4 individual variations, their overall results. Here is the Donchian period. So now Fred's embedded these parameter values into the performance results for each variation. There's variation 1, variation 2, variation 3, and variation 4. And then this last row, this represents the sub-portfolio itself of the 4 variations and the overall statistics for that.
So there you can see we ran a risk in column G of 0.5%.
Trade risk, 0.5%. So that, yep.
And so you can look at the MAR, the overall MAR for that whole run was 23%.
0.2302. So not a bad MAR for an individual market. And you can see that visually on the curve, because when you look at the curve, you can see that in general, it's been a pretty steady growth of the curve. There's been some small drawdowns in this zone here. So in overall drawdown, if you go to Fred's results here, the maximum drawdown in this instance was 4.6%. And the compound annual growth rate was 1%. Now, obviously, we scale this up. So this scaling treatment we're talking about, at the moment, we're running this on 0.5% trade risk percentage. So all of the scaling, etc., is done at the portfolio level when we start bringing all of these markets together.
The other thing that's interesting, if you want to bring up the portfolio equity curve, equity spreadsheet, and draw a curve across all of those, you'll see how they each individually performed.
Wait one, mate. No, now you're putting me under pressure. Draw a curve on each. Okay, so here we go.
Don't grab the top row, just grab the rest of it. That's it. Just insert a graph. It looks like you got multiple entries in there again. You probably want to get rid of those multiple.
Mate, you're very clever. This is what programmers are good at, Darren. They're quite clever people. Funny little chaps. You find them under rocks in places, but mind you, always put the rock back. Wait a second.
Well, that didn't work very well, did it?
Oh, Jesus, Fred. I thought you'd have been navigating me through this exercise. Wait.
Well, you could have just spanned the data for one range and forgot about everything else.
That's a programmer speaking again. Sorry about that. Me no compute. Jesus, what have you... I think it's your... Is that better?
Yeah.
Yeah, I don't love that. Wait.
Close that and start again, mate. Close that off.
Well, isn't that it?
Close the file.
That's it. Trust me.
That's it. You got it? Okay.
Jesus. This is pressure. This is on the spot.
You can see we really rehearsed this well, didn't we?
You're doing well, Rich, mate. Take your time.
I wasn't expecting Fred to suddenly put me... Yeah, you know, if Rich draws a chart on this...
Well, there's your equity curves, individually and combined.
That's a combined, the green beast, and these are the individual contributors, the 5 variations. Now, Fred, I won't put an equity, a drawdown signature on this one, mate, if that's okay for you.
Why not?
No. Okay, so there we go. So that's pretty good, Fred. I like that.
Well, it shows you graphically what's been going on, and I think that'll make it a bit easier to understand.
Now, interestingly, you know how we talked about non-correlation, uncorrelated return streams. So if you have a look, this one here relates to this particular value set. This is definitely almost anti-correlated to the orange set. See that?
Yeah.
See how they're almost anti-correlated to each other. So we're finding correlation benefits in the system value diversification. So a lot of people say, oh, you don't get much benefit from system, multiple systems. Well, you actually do, even on the same system. When you start looking at these long-term return streams and you start looking at the degree of correlation between those return streams, yes, you can get marvellous non-correlated benefits. And I was talking before about what we refer to as co-integration. So imagine a hedge trade. A hedge trade is where you take a short position and you take a long position at the same time. Now, when you have a hedge trade, you have this static zero relationship over the course of a hedge. They're perfectly offset each other. Now, that is not correlation, that is co-integration. And that's because of the design. So co-integration is a much more static way of looking at relationships between return streams. When you've got a design relationship, you can actually have a static design relationship. For instance, we've got a 100-period Donchian breakout, and we've got a 300-period Donchian breakout. The difference in that design forces the fact that you will never get one occurring at exactly the same time as another trade, that they are offset. Now, what that does is it forces this co-integration as opposed to correlation into the relationship. And so with design changes that Fred's been making, we get this additional little benefit with the non-correlation because of co-integration. Does that make sense?
Yeah, it's a little bit beyond me too, that description.
Well, co-integration is a good example is when you take a dog for a lead. You have a lead between you and your dog. You are co-integrated together. So you tend to move together because of that lead. That lead is a structural constraint that prevents the two from separating too far. When you get correlation between markets, at periods of time they are uncorrelated, at other periods of time they're correlated. So the degree of separation can be very, very large. But with design relationships, you can actually force a structural relationship between the two return streams, which is fixed and stays fixed over the course of the time series. So that is the difference between co-integration and correlation. Does that make sense?
Yeah, and the common factor there is the price, obviously.
That's right. So, but with Fred's designs and the fact we're forcing these through the iterator to get the best sub-portfolio result, it's deliberately looking for designs that offset each other to get the best risk-adjusted return.
Yeah, we're looking to get that smooth equity curve, aren't we, in terms of getting the best MAR?
Yes.
And so we're finding combinations that deliver that MAR result, which is why we're getting the results you're getting.
Yes, and because we're applying this to the same market. This is a coffee market, so all of these solutions are applied to coffee. So the price of coffee was doing the same thing at the time that this was getting a positive result on the equity curve, and this was getting a negative result on the equity. These were effectively hedging each other out over these periods of time to a degree. These others were contributing to overall positive equity. So that's why we've been diluting the drawdown impact of the overall sub-portfolio by this combination of strategies.
The other thing that's interesting here is the x-axis there is in months, as opposed to the MT4 graph, which is in trades. And so they both represent the same dollar result, but the MT4 is trade by trade by trade without any relationship to date, whereas the chart on our spreadsheet is date related.
Yes, good point. So that's a bit of interest. So yeah. So that's the equity. We've looked at the performance files. Darren, what else do we want to talk about tonight?
That's a good question.
Oh, what about the markets? Come on. Look at what happened today.
Which markets?
Okay.
All of them.
Well, all of them. So I woke up this morning and I came to my Twitter feed before I even looked at the markets, and there was a bit of chaos there. So overnight,
I've heard a rumor of the chaos. To be honest, I haven't been looking.
oh mate, oil was down 30%. So the deal between the Saudis and the Russians broke down, and so the Saudis have reverted back to their practice of high peak production and significantly increasing supply during a time when the global economy is hanging by a thread with the coronavirus, looking at decreasing economic activity. And so the oil price absolutely took a tumble, 30% down. So the headwinds of that, of course, was the uncertainty surrounding the coronavirus and who was reporting correctly, and whether China was understating and whether the US were understating. And we, on the weekend, that sort of started turning negative, where it looks as though it's a bit bigger than we thought. And then with the Saudi break, suddenly every market started going haywire. So, the Dow just absolutely had a huge, the S&P had a huge gap down, and I think it went through trading halts during the course of the day. So the basis of the S&P is that if it's down 7%, they halt for 15 minutes. If it's down 13%, they halt for 15 minutes. But if it's down greater than 20%, they halt the entire exchange for the day, I think. But anyway, we're in that territory today, and our Australian stocks, because Australia is very sort of dependent on resources and oil and the mining company, China, and so we might have escaped the GFC, but we're not going to escape this beast. And some of our stocks like Santos were down 30% for the day.
The index dropped 8%.
And the currencies got hammered. The Aussie dollar absolutely got nailed. The Japanese yen just took off.
What's happened? What's happened to the US dollar?
Look, what I'll do while we're here, I'm just going to bring up. I'll bring up
some. Historically, when these kind of events have occurred, it's been very good for our strategies in testing, hasn't it?
Absolutely, mate.
It would have been really nice to be live on some of this stuff today.
Yeah.
I just
grab us a chart, Rich. What do you got?
I've just I've got my live chart up there. I'm going to take that off. I'm very cautious about.
You got the dollar index there. What's that look like?
Okay, so let's bring up S&P for a start. We'll bring up the daily.
We'll go for the hourly. That'll be more interesting.
So this is a halt. This is obviously a halt, I'd say.
Yeah.
Pepperstone. It gapped, big gap in the morning, and just bang, straight down. Look at some of the currencies. Look at the AUD USD. I think got absolutely slaughtered. Did it? Yes. That was.
Come back again.
It's come back. That was its range today. AUD JPY. This is always a good telltale sign here. So that's on its descent down. Let's look at that in the context. So in the context of the monthly chart, we're going to be coming back to these levels back in 2006. So interesting. Let's have a look at crude oil. Here we go. Wait a sec. Let's get crude. Here we go. Bang! So it's come down during the course of the day. It was down 30%, but the only thing we can guarantee is we're not going to see that at the Bowser. It's pandemonium at the moment, and the good thing is, okay, so with a trend following model on oil, we would be short, and then we'd be sitting in this benefit land with significant profits.
Possibly. Depends which trader. We might have been stopped out on something there.
Yeah, once I get the EA up and test it over the crude, I'll put it over this. We'll see, but my gut feel tells me we'll be cleaning up. AUD JPY. Well, clearly we're in a downtrend here. We'd be doing very well. So our trend trading. Fortunately, these moves are not dead cat bounces. So there's maintained increased momentum with the original trajectory. So as trend followers, we'd be picking up on what they could term this crisis alpha. When everyone else is getting hurt, we're the ones benefiting.
And nobody really could have seen this coming. This has come out of an unexpected event that you couldn't.
I don't know. The coronavirus has been talked about for weeks now. And people.
That's not really a black. It's not really a black. Well, the oil almost was a black swan event because no one saw that coming. But coronavirus was definitely around. We've seen that pick up as a pandemic progressively into possibly a pandemic. So.
Yeah, but the it's always easy to say that with hindsight, but the markets were trading, if you talk about the S&P 500, at all-time highs. People weren't getting out of those positions, were they? I mean, people have been trapped at those highs.
Well, imagine who's been trapped in this. The buy and holders, the pension funds, they're the ones that are going to be hurting at the moment. And I really feel sorry for them because who knows where this is going to end? In the context of where things are sitting with the S&P 500, we've had since the GFC. Look at that huge bonanza lift in the S&P. Now, that doesn't necessarily imply underlying productivity there. That to me smells of quantitative easing and debt-fueled buying. So there's an incredible amount of leverage sitting in here, and we've only come off this level. So if we retract down to, say, this level here, that's going to be damaging. That's going to be very damaging. So, but we just don't know where it's going to go.
Have you guys seen that coronavirus website showing where it is?
I'll bring it up.
Like the world map with cases and.
Yeah, let's have a look at how this is spreading. So, thanks to Fred, he gave me a hot tip on where this one was located. So let's have a look. I left it when there was about 87,000 cases. I think it's
111,000 now. Do you want to get rid of that little box off your screen, mate?
Where is it?
Top right.
Top right?
Oh, that's actually me, I think. So,
yeah,
sorry, mate. Keep going.
No, that's a programmer, Darren speaking. So, total confirmed, total recovered. Total
Just zoom out on your map a little bit.
Look at those red dots.
Ooh,
Okay.
God.
That's where you don't want to be.
Well, I've just booked flights to Bangkok, so...
Forget it, mate. Forget it. I know Nick Raj is somewhere in Japan, and I saw a picture of him on his flight to Japan, and he was the only one in the entire plane.
You probably booked it out.
Yes. Well, no, he did say it's a bit lonely in here. So, but I tell you what, he'll get a very good, service to client ratio when he's over there. He'll be having a great time. So,
it is pretty scary, isn't it?
Oh, look at that!
Europe's going to overtake China by the look of it.
I'd say so. Look at that. Look. We're getting bigger.
Yeah.
The dots are getting bigger.
Yeah, but the bit in the middle, there's nobody there anyway, is there?
No.
Well, a lot of these countries, I think, are probably not reporting.
Well, Indonesia's not, so you've got no idea what's going on there.
Papua New Guinea's probably infested with it. We just don't know what's happening over there. Africa, there'd probably be a hell of a lot of underreporting in Africa. So, look at this.
Well, you can think about me at the end of the month. I'll be on a cruise to Vanuatu, so that'll be interesting.
Yeah, well, you are going on.
You're going on a cruise.
He's going on an incubator. I'll tell you what. Make sure he's done all of his programming before he goes, Darren.
Have you got this insane mad rush to buy toilet rolls in Australia? Is that happening there?
Mate,
we started it. We started
it. Australia started that trend.
In the pub, I've had to put the toilet rolls behind the bar, and the customers have to pay a deposit when they want to use the toilet roll.
Exactly. How it should be. You know, I thought over here we'd be using eucalypt leaves, but no, toilet rolls going off the shelves.
Yeah. All right, guys. We about done then?
I think we're done. So, look, just in relation to what's coming up, Fred has now finalised the enhancements to the EAs that we'll be getting out to our forum members, and Fred's also looking at the combo trader. Fred, do you want to just give a bit of a rundown of the combo trader?
Yeah. Well, what we wanted to do was take the data that we've generated from each of the individual strategies and combine them into a combination, a combo. So we've got, as Rich has already outlined, 4 different strategies currently on the table. There's 2 more coming, so we'll have 6, plus we don't know where we're going to end. But the idea then is we've got this data, we've done all the iterations, we've done all the optimizations. We're now going to grab all the data we've received out of those individual runs, throw them into a big super pool of data, and do the same thing again. We'll iterate between those. So at the end of that iteration process, we'll end up with 10 or so strategies, and they could be drawn from any of the available individual strategies, but then we'll have a Euro combo trader, if you like, that pulls together the donkey and the moving average, whatever else happens to be part of that combination. So that's where Rich was talking about the scaling, because some of them do behave differently, and so we might have to think about how we combine those together. But
yeah, it'd be interesting to see which mix of strategies actually makes the best portfolio.
Yes.
And
what I like about that is it's fully systematic. We're not actually making the decisions. We're trying to make it as systematic as possible.
Yeah, take discretion out of it. The only discretion might be in terms of the choice of the design decisions initially, but after that, it's all automatic. So once we then develop a combo trader for each individual instrument, the next step beyond that would be to combine instruments together to come up with a super maxi, if you like, of everything. And then we'd end up with probably the ultimate trader at that point.
Cool.
All right.
Okay, guys.
Thanks for chatting.